It may seem like the IPO calendar has been heating up, but our next guest says don't be mistaken. In his view, the crisis is far from over and initial public offerings in the U.S. have virtually disappeared. David Weild is the senior advisor at Grant Thornton, founder of Capital Markets Advisory Partners. He's also the former NASDAQ vice chairman. David, welcome to the program. Thanks for coming in.
Thanks for having me.
So first question, you talk about the IPO market. Is this something that is just cyclical? I mean, you go through downturns in markets, or is there something deeper? Is there a structural problem with our markets?
There's an enormous structural problem, Pimm. We have, if you look at the market and you start charting it back to 1997 when they put in the order handling rules and the manning rules that started to cut the profitability out of supporting small cap stocks. And I think that really what hurt most of the market in terms of obfuscating the understanding of what was going on was we were in the middle of the bubble. But if you actually cut through the data, what you start to see is we're actually delisting more companies than we were listing during the bubble, which is something that most people, I would posit, have no understanding of.
And it wasn't just that the companies were delisting, it's also the types of companies, right? Because it's not just that we're faced with the prospect of fewer IPOs, it's that small and mid-sized companies really just can't get funding in the public markets.
Well, that's right, or the cost of their funding goes up because the value of their stocks go down because of the lack of quality research and sales and capital commitment to support those companies. And so,
why is that? Is that something having to do with the way Wall Street is organized, how the finance industry it looks at trading?
Well, you can't make any money at all supporting smaller cap stocks. I was talking to your prior guest, Omar, and Omar, I asked him, what's the smallest size company that he covered in his universe, and he told me it was a $900 million market value company. And his firm, Dahlman Rose, is a boutique. It's a very vertically focused niche player. They do a phenomenal job. But for the fact that he tells you that the smallest stock that he's covering is a $900 million market value company, tells you that the economics are not in supporting smaller names.
And is this something that can be solved, or is this just an endemic problem with U.S. markets and it's just a maturing effect? We all end up looking only at the big companies.
Well, I have great faith in American ingenuity, and I think it's just like a 12-step program, that the first step is realization or acknowledgement that you have a problem. And the good news is that people are now understanding that this is a market structure, not a market cycle problem. So I think we're going to move it forward, the understanding, but what we need to do is we need to create a new market segment. This is a proposal that we made in the paper. Market structure is causing the IPO crisis, and it would be an opt-in market where we would have fixed spreads, fixed commissions that would allow companies to determine themselves if they needed to be in a higher revenue generating environment that they could elect in or elect out. And investors would then have the choice of transacting in that market or in the penny spread market, the Intels and the General Motors and so on, the large cap stocks trade in today.
But what kind of incentives would you think have to be given to the Wall Street firms in addition to actually get them to be interested in, let's say, providing that research for small and mid-sized companies?
If you have a higher spread and a higher commission, and I've sat down with people in smaller investment banks, and they will tell you that if we did that they would commit the resources to research and to trading and to sales to support those stocks. So I think that if you put the carrot in the right place, a lot of people will commit resources. Right now, we don't have the carrot in the right place.
What about Sarbanes-Oxley and all the rules and regulations attendant thereof? I mean, is that part of the problem?
Well, it's a great question. There's no question that Sarbanes-Oxley seems to have raised costs, but a lot of people would argue that the problems were really well before Sarbanes-Oxley. Sarbanes-Oxley was in 2002, and remember, order handling rules came in and the Manning rule came in 1997. Decimalization was in 2001.
Let me stop you there. Talk a little bit about decimalization and why you think that is also part of the problem.
Well, it took the price points from if stocks used to trade in quarter points or fractions, okay, so you'd have 25 cents in the spread. I mean, all of a sudden you fragmented that into 25 single penny price points, and what happened was the trader couldn't make money. That's right. Exactly. So, there is decimalization itself wasn't a bad thing. I mean, the fact is it's easier for people to calculate the cost of a trade when things are done in decimals. It also brings you into sync with the rest of the world. But we didn't have to take it down to the extreme of denominating everything in pennies. It could have been in dimes, 20 cents. It would have simplified it, brought it into the rest of the world convention. But the minute we took the order handling rules, if you will, and we forced the ECN order book, the customer limit orders, effectively to be within the spread and broadcast to the rest of the market, then traders could no longer kind of defend their position. The economics of the business were ruined. It doesn't kill you if it's a large cap stock, because Intel, lots of buy-side analysts, institutional investors that are following Intel, it's not going to get lost. Okay,
but it's the small and mid-cap stocks, those are the ones that get hurt.
That's right.
I want to thank you very much, David Weild. The topic that's not going away, coming in from Grant Thornton, talking about the crisis in the IPO market. Appreciate your thoughts.